Buying property as a buy-to-let investment is not the same as buying many other assets. The costs and process are very different from buying shares or classic car or even gold. In this video, I want to break down the true cost of acquisition and owning buy-to-let property. In the UK, we are fascinated by property, particularly buy-to-let investment property. There's about 2.5 million landlords in this country that between them own about 4.5 million properties, depending on what stats you look at. However, most landlords only own one property. There's very few landlords that own significantly more than a single buy-to-let investment property. So in terms of a percentage, although we have this fascination, there's actually only a small number of people that are actually landlords of more than one property. Landlords essentially make money from property in two ways. It's either by purchasing the property, then letting it out to some tenants and collecting a rental income, hence the name buy-to-let investing. Or the second way they tend to make money from property is by the increase in the value of that particular asset, i.e. the value of the property increasing. Now there's two ways that this can happen. Either there's an increase in value over time, the gradual appreciation of that asset, i.e. house prices going up over time. And generally speaking, what we find is many people that are either involved in property or interested in property have this general belief that over time house prices will go up, and whether it's 7 years, 10 years, 15 years, whatever it may be, over time house prices will go up and probably double in certain time frames. Let's say it's 15 years. Now, the other way to increase the value of the property is in a shorter compressed time and a forced appreciation. And the way that can happen is either by adding value to the property in terms of improving it, the condition, by renovating the property to make it much nicer than it currently is, hence pushing up the price, or alternatively by increasing the volume of the property and making it a bigger property. For instance, turning a 2-bedroom house into a 4-bedroom house. As long as you don't spend too much money, you'll make a profit there as well. So you're forcing up the value. This is the two ways that you'll find that most buy-to-let investors will make money from property. And of course, by leveraging that property, if they're using a mortgage, that means they've been able to make even more money than just tying up their own money in terms of being limited to what they're able to buy. And I'm going to talk more about that in just a moment. However, the acquisition and operating of buy-to-let property is very different than that from many other assets that you might look at in terms of the costs and processes that are involved. When it comes to property, there are really three types of costs that we're looking at here. The first one is those costs involved in terms of the purchase and the acquisition of the asset. Then you've got the operating costs when you're running the property, you're running it as a rental and have tenants in there. And then you've got other costs that don't really fall into those kind of categories. So let's now jump straight into number one, which is the purchase costs. Let's say we look at a purchase of £100,000, so nice simple numbers. It means that either you need the cash £100,000 to be able to go out and purchase that property, or alternatively you might be using a mortgage, which means you're borrowing 75% typically from the bank on a typical buy-to-let mortgage, and you put in £25,000 of your own money or 25% deposit.
You can't buy a property for 100 grand.
That's a good point. You can't get a lot for 100 grand these days. So let's look at say 200 grand property then. So that means you either need now £200,000 in cash, or you're borrowing 75% from the bank again. In this case, £150,000, and then you're putting in a cash deposit of your own money of £50,000, hence the 200 altogether to purchase the property. So that covers the purchase price alone. Now, just as a quick caveat, if you're purchasing, in this example, say a property and you're borrowing 75% from the bank, if you're in a location where the capital values are much higher, say for example down in the southeast, but your rents aren't proportionally as high, what it might mean is that the lender, the bank, may cap how much is that you can actually borrow. It may not give you the full £150,000. Now again, you're probably not going to get a huge amount for 200 grand down in London, for example, but the point being you need to be aware that there may be some restrictions in terms of how much you can borrow. Don't just assume it'll be 75%. Now, I've got a great video where I talk about buy-to-let mortgages in a lot more detail. Now, if it's something you want to learn about, we can link that up over here for you to watch that afterwards. If you are going to be taking on a mortgage to do this purchase, you've got to be aware there's going to be a whole host of fees and costs that you need to also be aware of when you're looking to use a mortgage. Now, just to be clear, I'm not a financial advisor, so I can't give you any financial advice. However, what I'm doing is sharing my knowledge and experience with you really for educational purposes. So what are the fees that we need to think about with regards to a mortgage? Well, the first one is a broker fee. You'll be paying a broker a fee. Now, you might be thinking, I don't necessarily need to pay a broker fee. I can just go to my bank, they can give me a mortgage, right? Well, yes, you could do. However, personally, I don't think you're necessarily going to get the best deal in the marketplace to do that, because what you're doing with a broker is you're looking for somebody that's independent and whole of market. So So what does that mean? An independent broker means they're not tied to any particular institution and they can access the whole of the market, all the products available in the marketplace that might be suitable to your needs, so they can pick out the best product for you. It's a little bit like, say, going into a Ford dealership to purchase a car and you say, hey, give me the best car on the market that suits my needs. Well, they can only provide you the best car within the Ford range to help you. And that's essentially what your bank can do. They're limited to only the products that they have available. With an independent broker, they will scan the market and try and find the best products for you, because they need to understand your needs, what you're looking to do long term, whether you're looking for interest only, repayment mortgage, whether you're looking for something that's going to be fixed for a period of time, looking for a tracker mortgage. All these things really need to be considered, and that's why a broker is going to charge you a fee for what they do. They also get a commission from the bank as well, or a kickback if you like, for placing that product with them, but you'll still be paying them a fee. The other thing that you'll be paying for when you're applying for a mortgage often is a valuation fee for the particular property. This is where the lender sends out a surveyor to be able to assess the property and make sure that it's worth what we think it's worth, and also assess that it's structurally sound, it's not going to fall down, it's not about to collapse, hasn't got no major problems, and essentially so they can approve it as good security for this particular loan. So what that means is that they're comfortable lending you the money and securing it against that particular property. Now, although you're paying this fee, the benefit of that valuation is not really for you, it's for the lender. So it may be that you're going to, early in your journey, and you want some more reassurance that the property is actually sound and suitable for what it is that you're trying to achieve. And it may be you might have an independent survey done as well. And that will vary depending on whether you want a very basic survey or very detailed survey as well, sometimes called a home buying report. If you do go down the home buying report route, remember they'll be very detailed and fairly comprehensive to an extent in terms of the look of a lot of things. But often what you'll find in these reports is that the surveyor will say these things might require more examination or something that might need exploring further. I can open up more and more things for you to look at. And if you're early in your journey, really sometimes that's been quite daunting. So really it's good to be able to bounce the ideas and the information you're getting from somebody more experienced, just to be able to get some feedback for them that you're on the right track. So valuation fees or survey fees is something you'll be looking at, as well as broker fees. The other big fee when it comes to mortgages is the product fee, i.e. the fee that the lender charges you to be able to access that product. And sometimes that fee just gets added onto the debt. So let's say you're borrowing £150,000 and it's a 2% product fee, which could be say £3,000. So that's added onto the mortgage. So rather than you getting a mortgage of £150,000, it may be you end up with a mortgage that's £153,000. So it isn't always obvious that you have to pay this fee. So it's all in the mortgage offer that you will have, but it's important to be aware of this is a cost that you incur. It may be you're paying it up front, it might be it's added to your particular mortgage. In some instances, you may also need to pay the legal fees of the mortgage provider, so that's something you need to be aware of. But generally speaking, when you're taking out a mortgage, you'll get a fairly comprehensive document that breaks down these costs. The reality is not everybody reads them in detail. I'd encourage you to do that. And remember, I've got an in-depth video on buy-to-let mortgages, so make sure you check that out as well. So you've got your cash deposit together, you've spoken to an independent mortgage broker, they've found you a great mortgage product, you've made the application, the surveyor's been out, they've valued the property, the lender's offered you a mortgage, they've given you the mortgage offer, it's all good. What next? Well, your solicitor is also now going to do some work for you as well. And you've got to think about the costs that they're going to charge you. Now, often it is that they'll give you a price for what they're doing. It may be, say, on a purchase like this, it could be £700, £1,000, £1,200, often plus VAT as well in terms of their fee. But when you get that completion statement at the end, the completion statement is the summary of a breakdown of all the costs and the things that they've incurred during this transaction for you, you find the solicitors have actually, the bill's gone to say over £2,000 now, or even significantly more. Why is that the case? Well, that's because what the solicitor is quoting you in terms of their fee is the bit that they do, but there's other things that they'll need to incur in costs for you as well, and they'll charge those to you. So what are those costs? So for example, you have searches that they make on your behalf. There might be insurance indemnity policies that might need to take out and pay for. Sometimes you can get the sellers to pay for these, but it may be some that you need to pay for. There'll be transfer fees they'll charge you, like 50 quid for transferring money. Does it really cost that much? Anyway, they've got transfer fees that they need to charge you. There might be anti-money laundering checks that they need to do. There'll be a fee for that. It may be they need to register the details at company's house because it's a company purchase that they're doing. There'll be a fee for that. There'll be a land registry fee as well. So when you start adding all these fees up, it does add up to a fair bit. So on a transaction of say £200,000, it won't be unusual to have a bill of more than £2,000 from the solicitor, which includes all these additional things as well. What else are we going to have as on that statement before we actually send over all our money and complete on the transaction? Of course, we forgot the taxman. Stamp duty, which is a big one, which is what's causing this massive rush right now of people trying to get transactions done before the stamp duty holiday period finishes at the end of June and then gets reduced down until the end of September. So what that means is people can make quite a significant saving on a transaction, but as investors, not only do we pay the regular stamp duty that everybody else has to pay, we get whacked with a whammy of an extra 3% as well. So that means we have to pay an additional 3% over and above the regular rate. So this is something you need to build in. So 3% on a £200,000 transaction, that's like £6,000 over and above the regular stamp duty. So when you add that in as well, that can come to quite a bit of money. So it's really important that we budgeted for all that when we look at the overall costs in terms of purchasing a particular property. Hey, I'd like to ask a favor. If you're enjoying this content, then make sure you smash that like button and also subscribe to the channel. That way it just really helps me out to get this content to many more people just like you. So congratulations, you now have your buy-to-let property. But hey, isn't the whole idea to be making money from property? So now rather than spending all this money, you need to get some income coming in. That means you need to get some tenants in the property. But just before you can do that, there's a number of things you need to think about. For instance, it may be the property first of all needs some work doing. It could be it's ready to go, but before you can move any tenants in, you need to make sure you've got the compliance bit sorted out in terms of certificates. So what certificates we're talking about? Well, you've got your gas certificate, electrical certificate, and also your EPC as well. They're not huge costs, but things to be aware of. For example, your gas certificate could be anything from like, £50, got up to like £100, for example, depending on how many appliances and things that they're testing for you. And you've got an electrical safety certificate, which is making sure all the electrics are fine. That certificate tends to last for 5 years, where the gas one is only for a year. The electric one might be say £150. It will vary, depend on what they're doing and throughout the country in terms of the cost that you'll pay for that. And an EPC generally will be under £100 that you'll be paying for an EPC. And an EPC report will last for 10 years. Often, if you're purchasing a property, you may already have an EPC with it anyway that you can use. You can need to check the rating. Sometimes you need to improve the property's efficiency before you can rent it out. So you need to check and make sure that they're compliant. So these things don't cost very much in terms of certification, but it may be you need to do some work on the electrics or the gas or the energy efficiency to get them up to standard before you can start renting the property out. When I'm looking at people's cost sheets when they're doing projects like this and I'm helping them analyze the deals, and one of the things I see being missed is when they're holding the property during this time, whether it's certificates that you need to get done or whether it's some work that you're going to get done to the property or whether you're waiting to market the property and find a suitable tenant, during that time, it's a void. That means you've got no income coming in during that time. So you're still incurring certain costs. What costs are you going to incur? Well, you still have gas that you need to pay for, electric you need to pay for, water bills, council tax, you'll need to pay for as well. So all these costs you're still incurring even though you're not actually generating any income right now. Now, there may not be very much, but you'll still have costs. So for example, you might not be using any gas, but you've still got a standing charge you'll be paying as well. So it's important to understand and be aware of these are all part of the costs that you need to build into your particular calculations. Of course, to be getting some money coming in, we need some tenants paying us some rent. And often many people will use an agent to find them a suitable tenant to move into that property. And of course, the agent will charge you for the privilege of finding you a suitable tenant in the way of a tenant find fee. But then once the tenant's moved in, there's also the ongoing management of that particular tenancy. And again, many landlords will use the agent to be able to take care of that property for them rather than doing it themselves. And if you are using the agent, then you'll be paying a percentage each month. That could be anything from like 8% to 15% of the gross rent being collected that you're paying in terms of a management fee as well. So that's a cost that needs to be built in. In terms of the tenant find fee, what you pay for that, again, that will vary from anything from half a month's typical rent. So let's say your rent is £500, it could be say 50% of that rent, so £250, or it could be a full month's rent even, like which is £500. In some cases, I've even seen it being higher as well. So it all depends what value somebody's bringing. That's why I say the thing that's important. So when you're looking at these services and you're buying in these services from other people and experts, whether it's your gas engineer, whether it's your letting agent, you need to think about how much value are they bringing, and is it somebody you want to build a long-term relationship with, and you look at what's a fair exchange for what it is that they're doing for you. So on your £200,000 property, you might be collecting rent of say £1,000 a month, which is £12,000 a year, and overall say 6% gross yield. And that's one of the ways of calculating it. Personally, for me, I try and look for the highest possible yield I can with a balance of the right type of tenants, because sometimes you can invite more problematic situations where the returns are much higher, where the running of those properties is not so easy. So it's balancing that risk and reward, how much effort you're putting in versus what return. But generally, around 6% is considered fairly norm in terms of from buy-to-let investing. Like I said earlier on, there's two ways to make money. It's not just the rental income, it's the increasing value of that property as well, particularly over time, which is why many people tend to hold property for the long term. But during this time, you're now servicing a mortgage, you've got a £150,000 mortgage, so you're going to be paying the payments on that each month. Now that may be an interest only mortgage, or it may be interest and capital repayment mortgage, which means it could be just the interest you're paying, which might be say 2-3%, something like that you might be paying as interest, but there may be a little bit you're paying towards the debt. Now which is the right one for you? Again, this is a conversation with mortgage broker, but I have done a great educational video just on that topic, whether it's interest only or repayment mortgages you can look at, and I'll link up that up over here so you can also watch that after this video too. Other costs to be aware of that you might incur is insurance, and generally speaking, as a bare minimum, you'll need building insurance. There'll probably be a requirement from your lender as well that the building is insured, but there's lots of other types of insurance you might have as well. For example, it could be contents insurance, it could be rent protection insurance. There are many different types of insurance. And what is insurance at the end of the day? It's some kind of peace of mind. That's essentially what it is. So depending on how much peace of mind you want, that will depend on how much you're willing to pay for that peace of mind. So there's lots of things you can insure, but generally speaking, as a bare minimum, you'll be insuring the building, so you've got that cost that you'll be paying each month as well. So what's the other one that I see many people that forget when it comes to costs in the operating of buy-to-let property? And that's allocating some money towards basic maintenance and repairs of the property as well. Often if the property is in good condition, you may not have much to spend, but sometimes you could get a surprise, like the boiler tends to be the biggest one. You just get, all of a sudden you get a boiler that needs to be replaced, and that might be a couple of £1,000 you have to cough up, and you may not necessarily have budgeted that. So I think it's good to allocate a little bit of money each month from your rental income towards this pot of cash that you can use towards the maintenance and upkeep of the property. It means you're keeping it in good order as well. It means your tenants will be happier as well. And of course, ensuring that your asset is being looked after. Now, if the property you purchase is leasehold, for example, let's say it's an apartment within an apartment block, then that means you'll have some additional costs that you need to think about as well. And those additional costs tend to be ground rent and service charge. The ground rent is a basic charge you pay literally for the building to be sitting on that ground. There's not a huge amount that you pay. It's a small payment each year that you'll need to pay as a contribution towards that land, if you like. The service charge tends to be a much more higher payment. It's a monthly payment. Now, depending on what the company that manages the building that will charge you for that. So this, for example, will be towards, it could be the insurance of the building, it could be landscaping, cleaning the communal areas, it could be painting, it could be servicing the pool, the swimming pool if there's one in the building. Whatever it is, the more and more facilities and niceness you have within an apartment block, your service charge will be higher, because that of course all needs to be paid for somehow. Now the thing is, when you're renting property out, you can't charge rent plus a service charge. Essentially you're charging a rent which be inclusive of all these things. So this can be a big cost within new apartment buildings as well to think about. And I think if you are purchasing apartments within a new build block, or even apartments generally that may not necessarily be new build, that you really look carefully at what the true cost of the ground rent and service charges are, because they're not necessarily always fixed at what they are right now. They could be increasing over time, so that you're aware of what those are, so you can make a nice long-term plan of the true costs of your property. So we've talked about two lots of costs. That's the purchase cost, your acquisition costs up front, and then of your operating costs in terms of when you're running the property as a buy-to-let. So your third set of costs are your other costs that don't really fall into these categories. So what might they be? Now let's say, for instance, you're refurbishing the property, so you need to allocate some money depending on the level of refurbishment that you're doing, whether it's a small refurb or a big refurb. So obviously that will vary. We tend to categorize them as a light refurb, medium refurb and heavy refurb. With a light refurb, really just mean that we're freshening it up, maybe redecorating, new carpets. That's what I would treat as a light refurb. And a medium refurb might be you're changing the kitchen and bathrooms as well, so modernize it in that way, redecorating it included within that process. And a heavy refurb literally is kind of gutting the property back to brick, replastering, replumbing, rewiring, everything, possibly re-roof extensions. So depending on the level of work that you're going to be doing in the property, you need to allocate an appropriate amount of funds. Now, if you reach this point of the video, that clearly you're still interested in buy-to-let, and you are understanding and learning more about the costs, and they're adding up and they're adding up. This is why it's really important to understand the model and the strategy that you're using, so you're getting the best possible results. When you're investing in property, I say you should always start with the end in mind. What I mean by that is you should have a clear and clear outcome in terms of what you're trying to achieve from investing in property, so that then you can apply that within the formulas that you're using to ensure that it's going to deliver ultimately what it is that you're trying to achieve through buy-to-let property. If your intention is to remortgage the property after you've added some value to be able to extract some more cash out of the investment that you've already made, then of course you need to take into consideration the cost of going through that mortgage process again that you might reincur. It might be another mortgage broker fee, it's certainly be more mortgage product fees, it could be another survey that you're paying for as well. So all these costs need to be factored in. You'll have legal costs as well to go in through that process again. Often I speak to people that are keen to remortgage and they've got a small amount of equity in the property, and I say to them, look, do you really understand the true costs involved in remortgaging and all the costs that you're going to incur versus how much are you actually going to pull out? Because it may be you're pulling out 10, 12, 15,000 pounds out of a remortgage, but you've just incurred 6,000 or 7,000 pounds of costs to get to that process. So you really need to take into consideration those costs before you can make a decision if it's right for you. Now, we've been talking about buy-to-let property, but sometimes people will be using this type of strategy where you're buying property really to add value, but rather than keeping it for rental for the long term, it may be that you want to flip it straight on. So this strategy we call flipping property, where the one we've been talking about now, where you're adding value and remortgaging, would be called BRRR. Now, this is a question I get asked quite a lot, which is a better strategy out of the two? So I've done a video on this topic before. We're going to link that up next for you to watch. But just before we do that, make sure you click on my face down here to subscribe to the channel. And remember, the most valuable thing that you have that money can't buy is time. So make sure you're using your time wisely.